Hello friends, welcome to Get Rich with me. Today we are going to cover all about annuities. As you know, I am the annuity queens. I am really well known in the industry for this, and I can't wait to share with you all of the facts and none of the fuss. By the way, I am your host, Dr. Dima El-Notour. I actually work for Efficient Wealth Group, and I cover the nation to help people retire and level up their financial games so they can live the lives that they desire. Now, when we talk about annuities, the market is very, very crowded. There's so much out there. And most people and most clients that I work with really get confused. So I decided that we're going to take a financial literacy segment and talk to you about annuities. So to get us going, we're going to start with the history of annuities, which many people really don't know about. The very first thing that I want to cover is annuities are so ancient. It's one of the oldest financial instruments in the US system. In 1759, there was a company in Pennsylvania that formed for the benefit for Presbyterian ministers. If you can imagine, back in the day, 1759, there was still some civil upset. And during that time, people lost their lives. Also, they didn't live very long. So they really worried that if something happened to them, their beneficiaries and their survivals would not have enough to survive. They decided to create a common fund, and that common fund, they would all contribute small payments, and if one of the members of the fund passed away, their benefits or their survivals would receive lifetime payments. So that was the very first point of the birth of annuities. Now, many Americans at that time really loved the idea, but they weren't part of groups or ministries. So they kept asking and nagging until companies came into the market. And for the very first time in 1912 in US history, annuities became available to the general public. So people like you and I could actually purchase an annuity. However, annuities really did not become very popular until the Great Depression. At that time, people were looking for ways to combat negative markets and protect their money and grow it. And so annuities grew very, very big in popularity. Now today, when you think of annuities, I want you to think of a contract. In the financial industry, we like to call this a paper product. Basically, it is a contract between an insurance company and an insurer or an annuitant, more specifically in this case. The contract holder would be you, the owner, and the insurance company would offer the annuity. In return for certain contributions, the insurer, which is the insurance company, would promise a certain type of payment for some period of time under specific conditions. So in order to understand how annuities really fit into the great picture of financial products, we have to ask questions. Very, very simple question about how many different types of annuities there are. But before we can talk about how many types of annuities, we have to see how many choices we have for our money. So in terms of how many choices we have for our money, think of a matrix. There is something called fixed products. Fixed products is very, very simple. You use those every day, has complete safety of principal, and very tiny returns. So a savings account, for example, is a fixed product. They declare the interest, the return that you receive in that account, which usually is very, very minimal, cannot even combat foundation, but it has a complete safety of principal. In case of a savings account or a CD, they are backed up by the FDIC. Now, on the extreme other side, there is something called variable products. Variable products, there is no safety of principal, but there is great upside potential. And the reason we all get into variable products is because we can't really rely on tiny returns. We need to invest. Variable product examples would be the stock market, would be private money lending, would be real estate. Any time that you could invest in a product where there is variability, where the original principal can be lost, that is considered a variable product. Now in the middle, what a lot of people don't know, there's something called index product. Index products is something that plays, it's not fixed and it's not variable, because the idea of an index brings great level of variety and stability to the instrument. Now, my firm at Efficient Wealth Group working with our clients, we specialize in the index products that provide both safety of principal as well as upside potential. We do not want to dabble into anything that has great variability because we truly believe that the market has plenty of options. There's really no shortage on those fronts. So we try to bring something new and much more needed. Now, index products, if you're not very familiar with them, Warren Buffett, of course you all know who he is, back in 2008 wanted to make a general point to the public. And so he published something called the $1 Million Bet, where he told hedge funds, if you come and bet me $1 million for 10 years, we're going to both start $1 million investment. You choose 5 funds, any funds you'd like, and I'm just going to invest $1 million in the S&P 500. At the end of the decade, we are going to look and see if I make more money than you do, you lose to me and you pay me $1 million. If I lose to you, I will pay you $1 million. Well, in 2018, which is 10 years after 2008, Warren Buffett ended up making $2.2 million. So he won the bet, telling us all that index products are superior to any handpicking. And at that point, of course, he donated the $2.2 million into charity. Now, index products takes the index concept from the stock market, like any S&P 500 index or any other index really, and it takes it one step better if we put it in an annuity contract. It gives us something called the 0% floor. So at this point, that means there's no negative returns, no negative market returns. So if that index dropped, I preserve. So I preserve what I have at that point and I don't take a step back. If the index move, I take a step up with it. So I am moving my money up and I'm preserving if the index takes a step back. In the meantime, each year that I get my return on the investment in terms of interest credit, I do not actually pay taxes on that because it is inside an annuity contract. Now it is protected. So that's what we call a tax deferral strategy. So all of the taxes get deferred. Because I am not really paying the taxes, what happens in essence is that money gets reinvested in the instrument and I make more money at the end of the day. The really brilliant things about the right index annuity is that at the end of it, when I go take the money, I only pay interest on taxes on what I owe. Whatever I take out, I could have had $1 million in this annuity contract because it grew over the years. And if I only need $20,000, I'm only going to owe taxes on that $20,000. So I really can control the release or the disbursements of the fund to manage my taxes better. Now, let's get back to the question that we've asked a little bit earlier in this episode, which is the types of annuities. How many types of annuities are there, you might ask? Well, as the annuity expert, I like to think of it in 3 main categories. There's something called a growth annuity. A growth annuity is meant to focus on growing your money. It grows your money and preserves it over time. It's an accumulation and a legacy product. There's something called income annuities. Income annuities are meant to make sure that you don't run out of money. That we also like to refer to them as self-funded pensions. The third kind is something called estate annuity. And estate annuities are focused on passing on funds very efficiently to heirs and other people. So those are the three kinds. And in retirement, really ideally, you want a growth instrument at a 0% floor, so there's not a step back in your net worth or in dollars. You would need a guaranteed income for life to protect from the risk of living too long and running out of money. And in estate annuities is really a luxury. If there is a reason to use them, you certainly can. The different types of rates of returns, annuities are an investment product, so we have to talk about rates of returns. There's fixed rates, there's variable rates. We don't touch the variable because, like I said, there's much simpler ways to be in the variable asset classes outside of annuity contracts. But we like fixed, we like indexed because we just learned from Warren Buffett and all this time that index products are superior. So if we take an index, put it in an annuity contract, we can even further improve the performance of these indexes. So fixed, variable, index, there is a guaranteed rate. You will find those very commonly in the guaranteed income for life products. There are caps sometimes, so they'll cap the rate to provide you the protection from the negative return, and sometimes there are no uncapped returns. The uncapped returns at times will come up with fees or will have fees associated with them. Now, annuities and the IRS code. I always like to say as an educator that there are two certains in life, taxes and death. So when you're talking about money, you always have to think about taxes. Now, the IRS looks at annuities in two very simple categories, qualified annuities and non-qualified annuities. Qualified annuities is for retirement money, both traditional and Roth. Rollover options are available. If you ever leave your employer, the better option is to roll over your old 401k from your previous employer to an annuity contract and manage that over time. So there is no, of course, tax implication to rolling over. The tax deferral for the accumulation gets preserved because it's in a qualified account. The distributions are taxed or not taxed depending on the source of the money. So if you rolled over a Roth account, there's no taxation upon distribution. But if you used a tax-deferred account, you certainly are going to pay taxes on the accumulation, or really on the whole account in this case, because everything has been tax-deferred. The second main category with the IRS is a non-qualified annuity. Non-qualified annuity for all non-retirement money, things like inheritance, savings. In that case, the taxes get deferred, and only the gains get taxed upon distribution. Now, the general things that we have to consider when it comes to annuities, we have to look at the terms of the contract, because remember, I did say to you that it is a contract product. So you have to look at the terms of the contract. Is it a 3-year contract? Is it a 5-year? Is it a 10-year contract? Is it longer? So you need to know what is the contract duration. You also need to understand during the active contract years, what are the terms for your access or liquidity? So most of the annuities out there will give you access to 10% of the principal of the annuity, meaning the entire amount, or the original principal that you brought in. So you have to take a look at the details, and most of them will allow you access 10% each year during active contract years, and after that you have unlimited access. There's also protection of principal, which is a very important point that we need to keep in mind. Crediting strategies and the indexes that are made up of it is really important. We have to keep that in mind. And then, of course, there are some riders, like well-being riders, LTC, other things like that. Companies and financials really matter. Now, the best type of annuity is a FIA, which is a fixed index annuity, and because it has both fixed and index rates. Thank you so much for joining me today on Get Rich with Me. And I hope you grew a little bit wiser, because financial education matters, because that is the only thing that will make you a little bit smarter with your money. When you know better, you do better. My name again is Dr. Dima Elnatur from Efficient Wealth Group. Get in touch so I can help you. My phone number is 669-888-6925. See you on the next episode.